This is the In Focus podcast from The Hindu.
Hello and welcome to the In Focus podcast. I am Nivedita. The Reserve Bank of India's Monetary Policy Committee, or the MPC, has decided to keep the repo rates unchanged at 6.5% in its August 2024 meeting for the ninth time. It has maintained its inflation projection for FY 2025 at 4.5%. While announcing the policy, RBI Governor Shaktikanta noted that the headline inflation reached 5.1% in June this year, driven by unexpected factors. Food inflation contributed to over 75% to the headline inflation in May and June. Vegetable prices alone accounted for roughly 35% of June's inflation. Governor Das noted that the MPC cannot ignore this, especially in an environment of persisting high food inflation. Food inflation has been on the higher side for months now, but core inflation has been low. In fact, core inflation saw a historic low in May and June. Monetary policy is a way to control the supply of money and credit in an economy. The aim is to limit inflation or deflation, as the case may be, and boost growth. The RBI has adopted a technique called inflation targeting to do this. It has a 4% inflation goal and it steers rates so this goal can be met. Some experts believe that high food inflation is stopping the RBI from cutting rates. In fact, the economic survey has suggested, and I quote, India's inflation targeting framework should consider targeting inflation, excluding food, unquote. The argument for this is that core inflation is muted, meaning the domestic demand is weak. A rate cut should help boost this demand. Others say that food inflation is very important and it cannot be excluded. I spoke to Dipti Deshpande, principal economist at CRISIL, earlier this week to decode the debate. Listen in. Hello and welcome to the In Focus podcast, Dipti Deshpande. How are you doing?
I'm doing very well, thank you.
So, the economic survey has called for a re-examination of the RBI's inflation targeting mechanism. How does this mechanism actually work?
So, the inflation targeting mechanism is wherein the RBI in the mid 2014-15 period took up inflation targeting, meaning that we now have a target in place. The inflation target for consumer price inflation that has been set is at 4% right now, and there is a band of about 2% below it and above that. The idea basically being that the RBI needs to now focus towards taking measures such that the overall or the prime motive is to keep inflation under control within that band. So there are times when they choose to have that band in place wherein they'd be comfortable with having inflation between 2 to 6%, or there might be times when they would want to keep it at 4% or bring it down to 4% like they have now. So that is basically an inflation targeting mechanism. We've chosen to keep inflation as a target rather than have an ad hoc target of sometimes looking at inflation, sometimes growth, or sometimes currency movements per se. So overall, from the time this has been adopted, it's brought in a lot of stability and also certainty or predictability rather to monetary policy actions.
So, if it's working very well, why is the economic survey asking for a change?
So I think this has been a debate for long whether it is the overall consumer price inflation index that needs to be targeted, or whether it is excluding food, because monetary policy by itself cannot control food inflation. I think that is the very simplistically made statement many a times. When you talk about the box item that the economic survey has in it, I think their perspective is basically from the farmers side. So what they are talking about is that typically when food prices rise, there is an opportunity for farmers to benefit from it. But because we follow an inflation targeting monetary policy, and the government also needs to support the RBI in keeping inflation under control, Whenever there are price spikes, the government takes steps to control it. These are mainly in the form of, say, increasing food supplies in the market by releasing stocks or allowing for imports or restricting exports, etc., which help to tame the price spike. So, from a farmer's perspective, there seems to be an opportunity loss because they cannot really make, leverage on the price spike per se. So, to some extent, that may be true, but I think this argument could only be partially right from a farmer's perspective, because it's not always that whenever there is a food price rise, the rise happens in all the food commodities. There could be years when you only see food grains seeing a price spike, and the rest, say vegetables, etc., are relatively low. And then there are years when, you see vegetable price spikes like we have in the last 1 year, and food grains aren't. So basically, for instance, if I'm a food grain farmer and I might benefit out of food grain prices going significantly high, but a vegetable farmer may not. He might actually have an adverse terms of trade because what he's producing is not fetching him as much of high prices. So I think overall, the government and the RBI, their final objective is to maintain price stability. It's not necessarily reducing prices, it's ensuring that there is a very gradual sort of a price rise over time. So they try to tame prices. I think that's the argument that's been going on, after looking at some of the arguments about re-examining the inflation targeting mechanism. But I think apart from that, there is also a macro impact which needs to be understood, because households in general in India tend to consume a lot of food. So completely taking that out of out of their cost of living index is not really the right thing to do.
It's interesting that this topic of looking at inflation targeting is happening now when we are at the lower end of the inflation scale. Some few years ago, we were hitting double digit inflation. So, if that situation comes again, so will we have to relook at the situation? We will have to relook at the policy again, right?
Well, see, I think from the context that you're bringing forth is that the double digit inflation, if it comes in from food prices, then perhaps a suggestion to relook at the inflation targeting mechanism, right? But I think that's where the real argument is. So, for instance, if you look at the average Indian households consumption basket, about 40 to 45% of our spending is on food. It's a little higher in rural areas, a little lower than that in urban areas. So one cannot necessarily ignore that sort of a spending tilt that we have. Now look at it this way. If there's a one-time food price hike, even the central bank as well as the government may ignore that. But if price spikes are persistent, like they have been over the last 2 years, then it can make its way, to the other parts of inflation, the non-food parts. Now, how does that work? And that works through a mechanism called the inflation expectations. So, if food price rise is persistent, households start expecting that the price rise at this pace is going to continue, and nothing probably might be done about it. But because food items, for instance, are purchased at a higher frequency, I would go every week to purchase food items versus a non-food item such as, consumer durable clothing, etc. It tends to build into my household expectations faster than the impact of price rise in non-food items. So now, if households start expecting prices to remain high, they would at some point start building these into expectations for their salary and wage negotiations, for instance, pushing up higher wage growth, because obviously they would want to seek a cost of living adjustment. Already, in some cases like Narega or dearness allowances of government pay, etc., it's linked to overall inflation, the headline inflation. So wages do rise at that pace. Now, as incomes get pushed over time because your food price rise has been persistent, demand for other items are also likely to go up, pushing up inflation in general. So, therefore, for a country like India, where the households consume as much of food, as 40-45%, it may not make sense to keep it out of an inflation targeting mechanism. Now, the role of monetary policy here, as I said earlier, they cannot directly control food prices. But the role of monetary policy here is to contain those expectations of households, by committing to stay at a low inflation regime. If I know that the central bank is going to maintain inflation at about 4 to 5%, and the role of fiscal policy of the government is going to be supportive in the sense that not only will they be fiscally prudent and not go out and splurge, but they are also going to take measures, appropriate measures to keep food prices under control, then the overall expectations can get tamed to that extent. So I think that's how monetary and fiscal policy work in tandem to overall control inflation, and in this context, food inflation and household expectations.
So, how will this play in taking into account core inflation? Core inflation, after all, doesn't take into account food and energy prices.
That's right. So I think, see, if you look at core inflation today, core inflation is abnormally low at about closer to 3% or so. It's never gone down that much and stayed that low. Average for the last decade or so is over 5% for core inflation. But honestly, we need to understand core inflation in a little detailed manner. So there are maybe two or three ways to look at it. First is probably core is low now because the impact of high input prices, because they shot up so much right after the pandemic and due to the wars, that impact is still waning away. So that's what we've been seeing for these months. But I think in the upcoming months, we are expecting core inflation to see a slight bump up because there will be a base effect, and also because some prices like tariff for telecoms, etc., have started picking up. So I think core inflation should see some bump up from 3% levels that we are seeing today. Second is, a weaker core need not necessarily suggest that the economy is not doing well. It may not necessarily suggest that there is weakness in demand only. It could also be reflective of the fact that perhaps supply capacity in the economy has improved. Now, we do not have enough data to necessarily or convincingly make that argument, but we do have some evidences here and there which may support this hypothesis. So, for instance, we've had policy and process reforms, in even in the pre-pandemic period, which have continued through this post-pandemic period. We see manufacturing growing at about 8% plus. Prospects for manufacturing over the next 5 to 7 years are much better than they were in the past. Investment growth is 9% plus, etc. So, all this does suggest the possibility that supply capacity in the economy is growing. Now, having said that, I'm not denying that consumption demand perhaps is weak, but in my view, the weakness is not being driven by high interest rates, and therefore, I do not think the monetary policy needs to be worried at this moment looking at core inflation, which is this low. Because if monetary policy was hurting demand, it would have been through, through lending, which would have come down. But we do know that credit growth remains strong even today. So, still, as of now, lending rates have not started hurting growth and demand, and therefore brought down core inflation. But we do believe that in the months to come, as lending rates remain, high, they will start pinching to some extent, and they could lead to some tempering of demand. But again, like I said earlier, the central bank remains inflation targeting. So unless it's comfortable with the inflation trajectory, a rate cut is unlikely to come by. So our expectation is that not before October is when they would start cutting rate, and even that after that, the down cycle is likely to be very gradual as the RBI balances inflationary pressures, growth concerns, and also external headwinds.
So, how does the RBI look at core inflation versus retail inflation? Does it matter to the RBI when making a decision?
So, core inflation is a subcomponent of retail inflation. About 47% of the retail inflation basket is core, about 45% is food, and the remaining is fuel and couple more components. So, yes, I think they are worried when it comes to core, because if core starts rising, it takes time for core to come down. It's the more stickier part of inflation. Unlike food, wherein if you have good, rains like we are having this year, it has the ability to bring down food from say 8% to 4%. But core is a very sticky number per se. So now with core having come down, it's giving them a lot of comfort on that front, and therefore the spike in food inflation is also not therefore pushing up overall inflation to such great heights. Now in the coming months, while we are expecting core to bump up a little, we are not expecting it to go up very significantly. It's just going to be a relatively mild bump up, because overall private consumption also remains relatively weak.
How the RBI can maintain good demand for products, keeping, as you said, hoping the core inflation bumps up a little but not too much, but also keeping food inflation in check. How can they do it in the long term?
Yeah, I think very tricky. Honestly, in the long term, the only route that RBI can take, or largely, predominantly, is via lending rates, by keeping lending conditions comfortable. Even today, if lending rates have gone up significantly from the pandemic levels, overall liquidity in the system is quite comfortable. We ourselves come out with a financial conditions index which tells us that the financial conditions in the economy are quite comfortable. So to that extent, lending rates aren't hurting growth. So even if the RBI were to start cutting rates over time, I mean beginning October as we believe, it's going to be a mix of keeping lending rates overall at a level where those who need to borrow are able to borrow it at reasonable rates, and also keeping liquidity basically, point being, they're going to use both the tools very effectively. It's not going to be too much of leaning on rate cuts or rate hikes or liquidity only. It's going to be a mix of both. But I think, to answer your question in terms of what can be done for private consumption to strengthen, I think there's a bigger role that fiscal policy can play rather than monetary policy by itself, in terms of propelling private consumption, keeping it strong over time, etc. Now, even when you look at private consumption, there is a need to look at it from the perspective of a short-term impact and a long-term impact. In the short term, good agriculture incomes, if we have good rainfall, food inflation being low, and government spending that the budget has recently announced on some of these schemes like Narega and PMGSY, PMAY, etc. Those can prop up consumption in this particular year. They can at least strengthen it from where it's gone. But overall, we believe consumption could see some sort of a softness from the urban side, because high lending rates could have an impact. So I think this is the short term dynamics. But over time, over the longer run, for consumption to be self sustaining, for the lift in consumption to be self sustaining, employment opportunities will need to be improved. Permanent incomes will have to go up, and I think all of that will require a greater role of fiscal policy than monetary policy alone.
Okay, thank you so much, Dipti, for explaining to us in detail the uh, debate.
Thank you, my pleasure.
In Focus will be back soon with analysis of the biggest news issues. In the meantime, you can find our podcast on Spotify, Apple Podcasts, Stitcher, and other platforms. Just search for In Focus by The Hindu. We'll see you soon.